focusing on property, but now what we need to do is we need to switch gears. We're going to talk about the liability portion, because remember, homeowners policies are package policies. This is the section we dealt with before, section 1 with your property, but now you also have liability concerns as a homeowner or just as a private citizen, and those are actually covered underneath section 2 of your homeowner's policy. Now, personal liability is actually divided up into 2 letters, E and F, okay? So we had A, B, C, and D before break. Now we're going to talk about E and F. The first one we need to talk about is personal liability, all right? So it's a combined single limit, which means it doesn't matter if it's property damage or bodily injury, they will only pay up to the minimum amount in Kansas is $100,000. And yes, you do need to know that, all right? If you buy a homeowner's policy in the state of Kansas, you can't have anything less than $100,000 per occurrence. But I want you to think about this. Is $100,000 per occurrence a sufficient enough limit?
No.
Because if someone wants to sue you, how much can they sue you for? There's no limit, right? I mean, if someone wants to sue you, literally, they can sue you for whatever the heck they want to, okay? So if you only carry $100,000 per occurrence on your homeowner's policy, the person you're really kind of hurting there is yourself, because in the event that someone sues you for $1 million, yeah, your policy takes over for the first 100,000. Who's going to take care of the next 900? Okay, so that's something you have to remember there. Now, can that be endorsed to be higher? Absolutely. But if you endorse that limit to be higher, what also goes up?
Premium.
Your premium. Okay. All right, so coverage E, this is what it'll do. If a lawsuit or a claim is brought against an insured for damages because of bodily injury or property damage caused by an occurrence, the insurance company will do 2 things. Number 1, pay up to that limit right there. Whatever this limit is, whatever we set it at, that's what they're going to do, number 1, for bodily injury and property damage. But here's the second part. We've already hit on this once, but we need to hit on it again. It will provide a defense at their expense, right? They defend you, so they pay for it by counsel of their choice. Even if the suit is groundless, false, or fraudulent, they can investigate and settle any claim or lawsuit that they decide is appropriate. So do they have to defend you? No. I mean, they might just say, hey, it's an open and shut case, we're ready to pay. All right, but sometimes if they want to defend you, they're still going to do so, even if they don't think that they can win. Our duty to settle or defend, though, ends when the limit of liability for the occurrence has been exhausted. What does that mean? Guys, it doesn't matter how much is spent here, but once this limit gets hit, right, once the judge has finally been like, listen, insurance company, you drug your heels long enough, just pay this claim and be done with it. Once they pay up to this limit, they can't defend you anymore, okay? So this doesn't affect this limit, but this stops once that limit gets hit. Okay, that's what coverage E is. And if you want to think about it this way, coverage E comes to your defense if someone wants to sue you, right? If someone wants to sue you, bring a liability lawsuit against you, this is what's going to happen. This is what coverage E is designed to do. Bodily injury or property damage, it doesn't matter, all right? But I don't know if you're anything like me, but if someone, and like I said, you got to make this personal, right, in order to make it memorable. If someone is going to sue me, I consider that a financial attack against me and my family. And if you sue me, I'm probably going to consider you to be my what? E. Coverage is for my enemies, okay? That's what E, that's how I determine what E is, personal liability. Someone's going to sue me, I'm going to be covered for it. Maybe not all that much, but at least I'll be covered for some. That's E, personal liability. But you also need to know the second part of your liability coverage. It's called medical payments to others. It's coverage F underneath your homeowner's policy. And look what it's going to do. It's going to pay necessary medical expenses that are incurred or medically ascertained within 3 years from the date of an accident. So please underline that time frame, because you will need to know that. Within 3 years from the date of an accident. So what are medical expenses? That means anything like medical charges, surgical charges, x-ray, dental, ambulance, hospital, professional nursing, prosthetic devices, and funeral services. That example I used right before lunch. I'm on Diane's property, right? And I hurt myself on Diane's property. Do I have the legal right to sue her? Of course I do. However, let's just say my injury, right, whatever happened to me wasn't major. Right? It was just something small. I twisted my ankle, broke a leg, whatever. And if we can find a way to keep the charges underneath whatever this limit is. Now, this is the minimum limit in the state of Kansas. It can be endorsed to be higher, right? But it sets out at $1,000 per person. So let's just say my medical expenses for that entire thing were like $850. Can I still sue her for that? I can, but her insurance company is going to come back to me and say, you know what? It fit underneath this limit, so we're ready to pay you right now. They're going to cut me a check and everything's going to be done, and here's why. It's payable for up to 3 years from the date of your accident because of these next 3 words. You got to know them regardless of fault.
Okay.
It doesn't matter who was at fault. Maybe Diane was negligent and left something out that I tripped over. Maybe I was a moron and tripped over something I wasn't supposed to. But there's not going to be any investigation here. There's not going to be any defense costs here. There's not going to be any court costs here. Why? Because the insurance company is ready to pay right now. That's what coverage F is, okay? Now, it's not that much, but of course, instead of going through the pain and the ridiculousness of a lawsuit, if we can handle it outside of court, don't you think we might rather decide to do that instead? Okay? So it's $1,000 per person, $25,000 aggregate. Remember what aggregate is. That's how much they pay in any one policy period, okay? Now, can those limits to be endorsed to be higher? They can. But if you do, of course, your limit or your premiums go up here as well. But coverage F is what's going to happen if someone wants to stay out of court, right? But this does not apply to you or regular residents of your household. Why? Because if you get injured or any resident of your house, if they are your relative, gets injured, what's going to have to cover you instead? You can't be covered under medical payments to others. You're going to have to be covered underneath your own health care, right? Your own health insurance, right? Because you're not an other, right? This is a liability coverage. E and F is liability, guys. And if it happens to an insured, that can't be covered underneath E and F, all right? So once again, E and F are liability coverages, so it can't cover you or regular residents of your household, who are your relatives. Once again, why? Because they are they are an insured, and insureds aren't covered underneath liability. So we know E is coverages from my enemies, right? Someone who's going to sue me, this is how I'm going to be covered from them. However, if I go to Diane and I'm like, hey, you know what? Let's go ahead and cover this outside of court, right? It wasn't all that much. And if we can find a way to do this outside of court, Diane's probably going to consider me to be her what?
Friend.
There you go. Coverages for my enemies, coverages for my friends. E and F. All right? Enemies and friends. In both cases, though, you're talking about liability insurance, covering somebody else. Now, are there also endorsements that you can add on to liability insurance? There are. Not a lot of them, but a few of them. But the one that you're going to run into today and definitely tomorrow is personal injury. Notice that does not say bodily injury. This is not a physical type of instance, okay? No one got physically injured here, but something did get hurt. It's someone's reputation, right? If you have someone wrongfully evicted, wrongfully accused of a crime, wrongfully terminated, right? That could affect them for the rest of their life, couldn't it? That could keep them from getting a job. That could keep them from getting a credit card. That could keep them from getting a house, right? That could keep them from getting a car. All of that could affect them for the rest of their life. Now, if I hurt someone's reputation, did I hurt them physically? No. Did I damage their property? No. But could they still sue me for something like that? Absolutely they could. And that's why adding that endorsement, not a terrible idea. Because your liability coverage will not cover you if someone wants to sue you for something like that. It's personal injury. You need to know that term. Watercraft liability. If you own a watercraft and you want liability to be added onto it, it has to be endorsed on. It's not automatic. We'll talk about watercraft as well tomorrow when we go over auto and watercraft policies and a home daycare. Remember how I said if you run a business out of your home, homeowners policies have no problem with that? Yeah, unless the business you're running is a daycare, when you're going to have like 6 or 7 children all underneath the age of 21 who are in your care or custody, yeah, the liability risks go up there, and yes, you do have to have a special endorsement to run a daycare out of your home. Okay, that has to be endorsed on. But other than that, there's really not a lot of endorsements when it comes to liability insurance. Also, there's really not a lot of exclusions either. Okay, so that's what we're going to talk about now. Things that wouldn't be covered underneath E and F. Okay, First off, bodily injury or property damage that was expected or intended. Well, gee, I wonder why that's not covered. Oh, because it's an intentional act. Right? We already said no insurance policy covers intentional acts. Now, let me run this situation by you though. What if my kid, who's definitely underneath the age of 13, goes over to one of my friend's house and picks up something really nice and decides, hey, I want to see what this looks like in 1,000 pieces, and just throws it on the ground? Is that an intentional act? Yeah. Can I still be covered by my insurance policy for it?
Yes.
Yeah, thank God, because of that term right there. Yeah, vicarious liability is what that is, right? When you are responsible for the actions of someone else. And yes, I am responsible for the act of my son, the covered peril. Okay?
But only up to 1,000, right?
Only up to $1,000. Yep. And they have to be underneath the age of 13. Okay.
13?
They have to be at least 13 or under. Yeah,
Okay.
under the age of 13. Or under 13, yeah, not 13 or under,
12.
underneath the age, yeah, 12 or under. All right, a business engaged in by the insured. This exclusion does not apply to part-time or occasional self-employed business for an insured who's under 21. What this is just talking about, guys, is as you run a business, someone can sue you because of how you're running your business or something that would happen. And what they're saying is you can't be covered underneath E&F for that. You need a business type of liability policy. And we're going to go into a huge detail of what those are tomorrow. But what this is talking about is like a teenager who wants to run like a lawn mowing business or something like that. Right? Parents could still be responsible for the children if bodily injury or property damage from that. Now, number 3, providing professional services. Let me just ask you this question. As you guys run your business, as you become an insurance agent, are you going to be giving advice to people? Mm-hmm. Yeah, are you going to be telling people where to spend their money? Mm-hmm. Yeah, I mean, are they going to be trusting you? Are you going to be giving them really good, what you think is sound advice?
Yeah.
Yeah. Are you going to make a mistake?
Yeah. Of course.
At some point? We're all human. And let me ask you this, I'm not saying it would, but could a mistake lead to your clients losing money?
Yes.
Yeah. And if you give bad advice and you actually leave something out, or you made a mistake and it caused your clients to lose money, could they sue you for that?
Sure.
Sure they could. Would you be covered underneath E&F? That's not bodily injury. That's not property damage. Okay? So in the course of doing your job, if you were to cause someone to lose money, you would not be covered underneath E&F. You actually have to buy a separate policy. And we're going to talk about what these policies are tomorrow in a lot more detail, but I want you to have something to cross-reference when you're studying. Okay, so I want you to write this term down. These are going to be called professional liability policies. There's a few of them we're going to be talking about tomorrow morning, but they're called professional liability. And guys, if you're not familiar with these next 2 letters, in the next month or 2, you will be. And those are the letters E and O. Errors and omissions insurance. That's what you're going to need as an insurance agent. Okay? And we're going to talk about E and O tomorrow. Number 4, the ownership, maintenance, use, loading, or unloading of a motor vehicle, except to service an insured residence, to service the handicapped, a golf cart used to play golf, or a toy vehicle for children underneath the age of 7 that is powered by batteries with a top speed of 5 miles per hour. I know we're getting kind of nitpicky here, but these are just the exclusions, right? Watercraft, except as provided. We already said that if you want watercraft liability, you have to endorse it on. Aircraft or hovercraft, except for models. Once again, don't ask me about drones. I don't know. You won't be tested on them. And number 7, property damage to property that is owned by, rented to, or used by whom? An insured. Because it's just going to boil down to one of 2 things. Is it property or liability? Okay? And that's why you have to know who's an insured and who's not. I mean, it really boils down to that. I mean, that's if you're getting down to the core concepts of what we've talked about so far today, guys, property or liability. Insured or not an insured. Okay? Excludes lawsuits from transmission of communicable disease, sexual molestation, corporal punishment, physical or mental abuse by an insured, and it also excludes the use, sale, manufacture, deliver, and transfer or possession of a controlled substance. But that's it. There's not a lot of exclusions here, right, underneath E and F. If you get sued and it wasn't for the result of one of these here, then your policy, your E and F should come to your defense, okay? Now, what we did also talk about, though, is that when we're talking about liability, that there's a set limit for what they're going to pay for, right? And that's all they can pay for damage awards. But that there could also be extra expenses on top of that that could be covered on top of that from our insurance company, right? Like defense costs, right? If they're going to pay to defend you, if they're going to investigate you, all those court costs, all of those are going to pay in addition to that limit of liability. So just like property had additional coverage, so does liability. Things that can't technically be covered as E and F, but the insurance company is going to help us out with it anyway, all right? So the first one we already talked about. Expenses that we incur and cost tax against an insured in any suit we defend. We know that that's not going to affect our liability limits. However, there are 4 more here that won't affect your limit as well. All right? The first one, $250 premium on a bail bond. So if for any reason you need to be bailed out, your insurance company will not provide the bond, but you can be reimbursed for it. Up to $250. Same way for an appeal bond. The insurance company doesn't provide the bond, but they reimburse you for it. The next one, this is key because you're going to see some examples of this even on the next practice test. Accrued interest after judgment and pre-judgment interest. Maximum interest rate in Kansas is 18%. Remember how I said if you sue someone, it could be a while before you actually see a penny? Right, so say I sue Diane for $100,000. I keep picking on you, Diane, but that's because you're right here, okay? So I sue Diane for $100,000, but yet her insurance company doesn't pay me for a full year. My insurance company now is not only going to go after her for that $100,000 that the judge awarded, but they're now going to go after the interest that could have accrued on that $100,000. So if they wait a year before they pay it off, now not only are they going to have to pay the $100,000, but they could end up being responsible for $18,000 more.
Wow.
Should that affect your limit though, Diane? Just because your insurance company wanted to fight that? No. That's why it doesn't affect it, okay? Accrued interest after judgment. And then the last one, reasonable expenses incurred by an insured at whose request? Theirs. Guys, if they ask you to be out of work, if they ask you to travel, if they ask you for this, they ask you for that, they've got to compensate you for it. They cannot expect that to go against your limit or something that you have to be out of pocket for. Okay.
So do you mean like if you go to the court or something? Okay.
Yep, and you have to be out of work, travel expenses to get to court, travel expenses to go to a hospital, travel expenses to go to a specialist, whatever, right? Anything that they ask you to do has to be covered underneath their dime. Now, there are 2 things though that you've got to know about all single of these payments right here. And the first off is this title. We call these supplementary payments. So please underline this phrase because this will not be the last time you see it. Why do we call them supplemental payments? Because these pay on top of, in addition to the limits of liability. They don't affect it, right? Supplementary payments. And guys, we just addressed homeowners liability, but this is not the last time we're going to look at liability. I mean, we're going to look at liability tomorrow a ton. With workers' comp, with personal auto, with business policies, and any single time you're dealing with a liability coverage, these supplementary payments will not change. They are found in every single one. Do you think you need to know this list? Yes. We're going to see it again tomorrow, okay? So definitely need to spend a few minutes knowing what these lists are and remembering what the term supplemental payment is. It's something that pays on top of your liability limit. It will not affect it, okay? All right, we're going to spend just a few seconds talking about the farm owner's policy. Why? Because you're not going to see a ton of questions over it. The very basic thing that you need to understand about farm owners' policies, guys, is this. It is a direct spin-off of the homeowners. So if you get a question about a farm owner's policy, the first thing I want you to think about is homeowners. How would homeowners cover it, okay? Because it's very, very similar. In fact, A, B, C, and D are the exact same letters, as you can see. Dwelling, structures, property, and loss of use. You have to, once again, be living there, though, in order to take advantage of a farm owner's policy. What if I own a farm, but I don't live there? Can I buy one of these nice little homeowners policies, or these farm owners policies?
No.
Nope. I'm going to need to get into the farm property forms and the commercial property, and oh my gosh, that's just going to be a huge mess. But if I'm living there, All I have to do is buy a farm owner's policy. Now, of course, there's some differences here, right? You've got scheduled farm personal property, you've got unscheduled farm personal property, and other farm structures. So the lettering gets off just a little bit. But the idea is still the same. This is covering all farm property. You get a question about what would cover a farm, like a tractor or something like that, that's your farm owner's policy, okay? Liability works the exact same way. Section 1 was property, Section 2 is liability. The liability limit is the exact same thing as it was under homeowners. 100,000 combined single limit. What's also going to be included here, though, is because a farm is a type of a business, right, is they will include personal injury and advertising injury. We haven't talked about advertising injury yet, but in the course of advertising your product, if you accidentally steal someone's slogan, steal someone's idea, steal someone's title, right, the copyright infringement, all of that could possibly happen, whether you intended it to happen or not, okay? They could sue you for that. We'll talk about this in a lot more detail tomorrow, but that's all part now of H. That didn't have to be endorsed on. Medical payments to others, same limit, $1,000, right? So once again, I gotta say this, because the Pearson VUE test love to throw in the, in the farm owner's policy, make you think that it's gonna be a specific farm owner's question, then it's like, what does A cover? Oh, well, come on, that's easy, right? So you've got to make sure you read through the whole darn thing. Do not allow the policy you're dealing with to dictate how you look at that question. Read through the whole darn thing before you make your decision. What we do have to spend some time on here, though, is the dwelling policy, guys. Dwelling policies can best be defined as property coverages. These are not package. Why? Because liability is not automatic. So if someone had a choice between a homeowner's and a dwelling policy, which one are they going to choose?
Homeowners.
Homeowners. Why? Because your liability's included, okay? Now the dwelling policy is going to be cheaper, but guys, the coverages are not as good. Now, one thing that is very redeeming, though, about your dwelling policy is this. Remember how the homeowners kind of jumped around? The HO2 was the broad, the HO3 was the special, the HO5, it just kind of made all of our heads spin. Yeah, the dwelling policies don't do that. There's 3 of them you're tested on. The DP1, the DP2, and the DP3. And it's just as easy. The DP1 is basic, the DP2 is broad, the DP3 is special. Thank you, dwelling policy, for making things a little bit easier on us folk here at the end of day 1. Okay? All right, so primarily, the dwelling policies are used for buildings that are being rented to others. Remember how I said a landlord could not buy a homeowner's policy for a home that they rent to someone else?
Right.
This is how they protect it, guys, with a dwelling policy. Okay? So if I am renting a home to someone else, I can't buy homeowners, now this is how I do it. I can choose one of these dwelling policies here. Now, dwelling policies also can cover homes that are owner-occupied. Right? Doesn't have to be something that's being rented to someone. Maybe I can't get a homeowner's policy because it's either too old, too small, I don't qualify for one of those other reasons. I can still maybe insure some of it underneath a dwelling policy as well. Eligibility, single family and up to 4 units. We kind of saw that earlier. Up to 5 boarders in one structure now. Farms aren't eligible, we know why. Businesses aren't eligible unless it's one of those incidental service businesses, right, which we already talked about. Okay. Now, all coverages, $250 standard dollar deductible, that's not true. It's $500 or $1,000 now, but you're not tested on that number, so it doesn't matter. But I want you to take a look at this chart, guys, because you got to be familiar just a little bit with how this chart breaks down. Now, A, B, C, and D all kind of still look about the same, don't they? Mm-hmm. Right? So how am I going to insure my house? With the dwelling coverage. Right? Now, of course, do I have to be living there now in order to insure it underneath a dwelling policy? Not this time. So if I choose a dwelling policy, let's say I choose the DP1, and something happens to my house, there's no co-insurance here, which means I can insure it for whatever value I want. Right? I can under-insure it and they can't penalize me. However, it's ACV value, so it doesn't matter if you under-insure it, because you're not getting a home back anyway, all you're getting is a check.
Yeah.
Right? The DP2 and the DP3, very similar to the HOs, right? The homeowners. Right? RCV with 80% co-insurance. We've already seen that. Other structures underneath the DP1, it's a 10% extension, which means that no matter what happens to your other structures, if you max out this value, could you get coverage for your other structure here? That's what an extension meant, right? It would only max out at whatever this was. 10% additional, it's the exact same way we saw over here, right?
So if it's just on B, like if just your other structure's destroyed, do you get covered?
You would be covered, yes.
Okay.
Yeah. Because remember, it's only going to pay up to the original limit of whatever A is, though. Yep, you got it. Good question. All right, contents coverage. C, 100% optional. Why? Because landlords, when they rent out a property, sometimes they rent it completely empty, right? They don't need contents coverage, do they? So why pay for it? All right, so contents coverage is 100% optional on the DP1, DP2, or DP3. But let me be very clear, and I have seen plenty of test questions over this. If you do want contents coverage, okay? If you do want it, which means you're probably living there, okay? You have to add on the broad theft endorsement. So you're gonna add in contents coverage, it's 100% optional. But remember how I said all HO forms had theft coverage in them? This one doesn't. Look at this. It provides the exact same theft coverage that's found in the homeowner's policy, and it should be added when contents coverage is selected. Why? Because of this note right here. All dwelling policies specifically exclude theft coverage. But you now understand why, right? Because contents isn't even automatic. So why include theft coverage? You don't need it. Okay, but if you do select contents coverage, choosing this broad theft endorsement, probably a good idea. Okay, so I have seen questions over this broad theft endorsement, guys. Please make sure you pay attention to that. Fair rental value. If I'm renting out this property underneath the DP1 and my property gets damaged, this is what I could be reimbursed for what that rental value was. 20% extension, which means it would affect A, right? My home's total, do I get anything back for my fair rental value? Nope. And it's limited to 1/12 of that extension per month. You want to know a layman's way of putting that? That sucks. You're not getting anything here, especially if your home's totaled, right? There's nothing you would get back here. DP2, DP3, much better. 20% additional amount, actual loss up to the limit. Remember underneath homeowners it was 30, okay? But here you at least get 20. Additional living expenses, not even available underneath coverage DP1. Underneath the 2 or 3, you get 20%. Theft of building parts. This isn't talking about personal property here, guys. Building part is something that's part of the building, right? Something that shouldn't be removed that actually ends up getting removed, okay? So if that happens, that's not covered even underneath the DP1. It could be covered underneath the DP2 or DP3, not by much though, 20% additional. And property removed to preserve the property. That's what this is speaking to, right? Where if I take property off of my property and put it in a storage shed, how many days would it be covered for? Typically it was 30, right? Underneath homeowners. DP2 and DP3, it's 30. Underneath the DP1?
5. Wow.
Yeah. So the DP1 coverage, I think we can all agree, sucks. Not good. The DP2 and the DP3 though are pretty much the exact same, except for that. Right? The broad is the named peril coverage, the special is the named exclusion, okay? Personal liability could be added in if needed, right? If I am living there, if I want liability coverage, I can add that in, but it's not automatic, okay? So not a package policy. Dwelling under construction provides coverage on a new home dwelling during construction. Coverage A limit is the estimated value at the time of completion. However, your premium is only 65%. Why? Because you're not living there yet. Okay, so you're not going to have to pay full premium. And of course, when your home is constructed, are you going to want to put it under a dwelling policy anyway?
Yeah.
Probably not.
No.
Probably what are you going to do?
Homeowner.
Oh yeah, go get a homeowner's coverage. Special provisions in Kansas endorsement is the exact same endorsement as it was under the homeowner's policy. Anyone remember what they were? Two different things because we live here in the state of Kansas that we get to take advantage of. What are they? I know it's mean to do this at the end of the
Like
day.
the tornado?
Nope.
No.
Two things. You live in the state of Kansas, we actually get special limits that other states don't. You have up to how many years to sue?
Oh, 5.
No, and now you're
Yeah.
awake. And the insurance company has how many days to pay a claim? 30. Guys, if you don't remember where this is, just put I think it's 2.1. Yeah, put 2.1 right down there, because it's one of the very first endorsement that we talked about. Okay. Last personal alliance policy we're going to talk about today is the mobile homeowners policy. And I need to once again state this. The mobile home policy, just like the dwelling policy, just like the farm owners, is a direct spin-off of homeowners. That's why we spend so much time breaking down homeowners, and we kind of fly through all the rest of them. Because once we've kind of broken down how one of them works, you know how most of them work. So the MH policies work the exact same way the DP ones did as well when it comes to the numbering. MH1, MH2, MH3, basic, broad, special. But there is one massive difference between this and everything else. And that is, underneath the MH1, the MH2, and the MH3, you can only insure it up to what type of value? ACV. But that would make sense though, wouldn't it?
Yeah.
Because if your mobile home is destroyed by a covered peril, are they going to go out and buy you a brand spanking new mobile home? No, they're not. Or else we go wreck them, right? We go find a way to make that happen. It's not going to happen for us, okay? So mobile home policies, MH1, MH2, MH3 are all on an ACV basis only, okay? They do not cover camping trailers or motorhomes. The mobile home also, in order to be actually classified as a mobile home, has to be permanently located, which means 3 different things. Put 1, 2, and 3, because you got to know them all. It has to be skirted, it has to be tied down, and the wheels have to be removed. Guys, if it's not skirted, wheels removed, and it's not tied down, you can't buy mobile homeowners coverage on it, because it's still in a position where it can be moved, okay? Now, your mobile homeowners policies do not qualify, or I'm sorry, your mobile homes, could qualify for a DP1 if you can't qualify for one of these MHs. But remember, the DP1 is like the last ditch effort. That's the last thing anyone ever would want, okay? And the policy would not cover the mobile home when it's being transported or when it's being moved to a new location. Why? Well, number one, it's not permanently located, but another reason is because it's in what? Remember what I said earlier. Any property that's being moved from one location to the other cannot be covered underneath your property coverages, okay? We will talk about the policy that will allow you to cover property in transit, but I don't want to bring it up until tomorrow because I've already given you so much information already today. I don't want to give you anything else. Now, what I want to do real quick before we get ready to take the second test is there's a little review sheet that I want to go over. Now, let me be very clear. This only has to do with property coverages, all right? This does not have to do with liability. So if you're still struggling with what liability is, you're going to have to go home and do some more review on your own. But I'm going to give you one more time today to practice your property understanding, and that is by filling out this chart. So let me just go ahead and hand this out real quick. There you go. There you go. And there you go. You want one? All right. Let me bring up my PowerPoint here. And I told you from the beginning of the day today that I felt like I was building a foundation, right? Building a foundational knowledge, especially when it came to property insurance. Because property insurance is one thing that people are just like, they've had some kind of experience on. They think they might even known how it worked. And it all boiled down beginning with one word. It's a word that began with the letter P. What word do you think you're going to fill in this first blank with?
Peril.
You betcha. Yeah, peril. Understanding what a peril is. What was Andrew Kemper's definition of what a peril was? The what of a loss? Cause. Yep. The cause of a loss. Why something happened. Then we took the word peril and we divided it up into a 3-category set, right? And these 3 words, we know we've used them a bunch today. What are they?
Basic, broad, and special.
You got it. Basic, broad, and special. Now this next one is way too small. I can barely even read it, so I'll go ahead and put it up here. But the basic and the broad are known as what kind of policies? Named peril policies. Right? The perils had to be named in order for them to be what? Covered. Yeah. And then of course the special coverage then was a named what policy? Exclusion policy. We have to know the reasons why things won't be covered now instead of reasons why they will. Which is why it's so imperative to know these perils underneath the named peril, because if it's not named, guys, it's not covered. So we said basic starts off with fire, right? Fire coverage. There were 3 perils underneath fire. One of them was unfriendly or hostile fires, okay? The other one was unrelated damage. Lightning, and then the last one was internal explosion. Then we had WARVs, and we do need to know how this breaks down. So, when we're looking at the extended coverage endorsement, because remember, that's what this is, the extended coverage endorsement. What did the W stand for?
Wind.
Wind, and yes, I said W, not W. It's my Midwestern accent, right? W.
W.
Wind damage, straight lines, hurricanes, tornadoes. That's the W stand for, wind damage. What about the H?
Hail.
Hail, yes. Hail damage to your roof, your siding. Hailstone comes and knocks out a window. What about the A?
Aircraft.
Aircraft, nice. No one's cheating during this time, right? Okay, I want to make sure. Aircraft, spacecraft, or missiles, right? But we said if it's not missile, excuse me, I need to keep up with y'all here. It's not missile, it's something projected toward your home, right? Okay, what about the I? Or not A, I, sorry, R.
Riot.
Riot. Riot attending strike, civil commotion, okay? What wouldn't be covered here is if that riot turned into an act to overthrow the government, right? Because then that would turn it into an act of war. What about the first V?
Vandalism.
Nope.
Oh.
Vehicle.
Vehicle damage. Yes. Vehicle damage. This isn't damage that's done to our vehicle though, right? This is damage that the vehicle had actually caused to our property. What about the second?
Volcanic.
Volcanic eruption. And it had to have everything to do with the eruption itself, right? Blast, lava, ash, no earthquake damage covered here.
So even if it just tremors, but nothing comes out, it's not covered.
That's not under volcanic eruption. You got it. What about the E?
Electrical.
Nope. Nice guess though. What kind of explosion?
Internal.
External explosion. Yeah. Internal was already covered up here,
Oh,
right? So this is external explosion. Another explosion that could happen outside of your home. And then what about the S?
Smoke.
Smoke. Yep. Smoke from a vented heating or cooking unit. But it is absolutely imperative you guys know these perils, okay? I just can't emphasize it anything more than that. Now, we understand what basic coverage is. To understand what broad is, what do? We take everything we learned under basic and we throw it up there, right? It's everything we just learned. On top of 7 more perils that we're gonna add in here. And I told you I didn't come up with a fancy acronym. VUFAFTA is what you got. So, VUFAFTA, yeah. Stop.
We'll never remember it.
Yeah, no one ever is going to remember that. All right, what about the first V in VUFAFTA? Vandalism and malicious mischief. Yep, you bet. But there was a caveat to this one. It said that my property had to have been vacant for less than how many days? 60 days in order for it to be covered. Nice job. Yeah, 60 days. What about the W in VUFAFTA? Nope. War is an exclusion.
Weight.
Weight, nice, yeah, weight of ice, snow, and sleet. Yep. But we're getting into the ones that it was harder to remember, so if you don't remember them, that's okay. What about the first F of VUFAFTA? Falling objects. Nice done, Jess. So yeah, remember this was the random object falling from the sky. Quite literally, our big blue ball of crap that fell through the roof. Yeah, everyone remembers that story. What about our first A? Yeah, this is getting into the sketchy ones. Nothing? Accidental discharge from appliance or plumbing. What wasn't covered here though?
Oh, the pipes, right?
The damage to the appliance, the damage to the piece of plumbing, right? I mean, your refrigerator could cause the damage. They're not going to replace the fridge. They're going to say, go buy a refrigerator. They're going to say, go buy a piece of plumbing. We'll just cover the damage itself, right? That it could have caused to your floor, to your cabinets, to anything else, okay? What about the next F under VUFAFTA? There was a caveat to this one as well, if that helps. Nothing? Freezing of pipes.
Freezing.
What was the exception here though? Freezing of pipes wouldn't be covered if we didn't do what? Maintained enough adequate heat, right? Because if we didn't maintain enough adequate heat, that actually turns that into an exclusion then, didn't it? What about the last two? Yeah, no one remembers these. Tearing apart of heater, air conditioner, or water heater. Tearing apart, yeah, it doesn't happen that much anymore, but, and I've never seen a test question on it, but I just want you to know it anyway. And the last one was artificial electricity damage, right? Power surge hits your home, it would be covered, our damage from that would be covered as long as it wasn't the electronics themselves. Now, remember, in basic and broad, the perils had to be listed in order for them to be covered. However, if something is listed here, if it's specifically identified under the special form, that means that it's actually not covered, right? So these are just some examples. These aren't the only ones, but these are some of the more common ones I see on the exam. So I wanted to list those here for you. War is one of the most easiest ways. If you see something that was damage caused by war, you know that's an exclusion. Okay? Wear and tear, smog, rust, mold, earth movement, unless you endorse it on, right? Flood, unless you endorse it on. Zoning laws, settling of buildings, land, remember I said that's never covered, unrelated tenants' property, and even industrial smoke. Why do I put that on there? Because I have seen a question that did ask me about industrial smoke specifically one time. That said a factory across the street from an office was puffing out smoke. The office opened up their window and the smoke came into their office and damaged some of their property. Is that covered? No, it's not. Because remember, that's not something insurance companies feel like they have any control or have any reason to pay for. Okay? All right. So now, as we kind of did this, we're kind of building this up, right? I hope you kind of see what we're doing here. And before we start talking about the actual policies themselves, we need to remind ourselves what A, B, and C are. A is my what? Dwelling. My home. It's where I live, right? And anything attached to that, attached garages, would be covered here underneath dwelling as well. B is my other structures. Sheds, detached garages, detached barns. And then C were my contents. All right. So now, hopefully, as we kind of build this foundational knowledge, you understand what we've been building to. And that was these policies, right? These personal lines coverages that I told you, you have to know at least something about. Now, I had great news for you. The MH policies and the DP both followed the exact same example, didn't they? Underneath all of them, they were both 1, 2, and 3, right? Basic, broad, special, 1, 2, and 3. So that's all you have to do to identify the perils that are covered or not covered, right? When you're looking at MH1, MH2, and MH3. It was the homeowners policies that screwed it up for everyone. So let's look at the only homeowners policy out of all 6. There is only one homeowners policy that actually dealt with the basic named perils. But we added in one more. We added in vandalism and malicious mischief because this was more specific to older homes, right? So we had to call it the modified form. This is the HO.
8.
Nicely done. The HO8, the older home in the modified form. And then we're going to jump over here to the far right column dealing with the special peril coverages because there's only 2 of them when it came up to the homeowners forms that were covered underneath the special. Now, there was one I told you was split, right? You got A and B coverages on your special coverage for this HO form, but broad name perils for your contents. It's split it down the middle. This is the HO what? 3. Yep. And then there was the one that brought everything back underneath the same umbrella. Your dwelling, other structures and contents under the HO 5. That's the one we called the comprehensive form, right? Everything came back together underneath one umbrella. But these are the only two that deal with the special form. That's it. The other three we're dealing with only deal with the broad form. So once again, let me state, if you get any question about anything being split, something between special and broad, you know that's the HO3, because none of the rest of them do this. Okay? All right, so now we're in the broad form. We're in the last three. What is the one where your dwelling, your other structures, and your contents are all covered underneath the broad form? The HO what? How many syllables?
Two.
HO2. Broad form, HO2. Okay. Then the next one said you didn't need to worry about your dwelling. You didn't need to worry about your other structures. Why? Because you didn't own them. But if you're renting a piece of property, you still probably need to cover your contents, and that was called the HO what?
4.
Rent.
Rent, R-E-N-T, 4 letters in rent or contents, broad form, HO4. And then of course the last one, the condominium form, says you need to cover your inner shell, so there will be an A, but it's not going to be as much. You don't need to worry about other structures, but you do want to cover your contents, and that is the HO
6.
condominium form HO6.